Morning everyone, welcome to the week. It's Monday the 17th of January. Today we're presenting the second part to the gold outlook from the World Gold Council. On Friday we brought you part one of the latest report. Today talks more to inflation, real interest rates, market volatility and gold drivers. Okay, opinion is divided, but inflation may linger. Many central banks initially played down inflation concerns, and while some, such as the Fed, have acknowledged upside risks, there's an underlying expectation that inflation will dissipate. Investors seem to be less sure, but opinions vary. Anecdotally, those views were echoed in a LinkedIn poll we conducted last December. While the vast majority expected inflation to remain high, more than 1 in 4 respondents thought it would cool down. We believe there are multiple reasons why inflation will remain high, partly stemming from the unprecedented monetary and fiscal policies put in place to alleviate the effects of COVID-19. In particular, lingering supply chain disruptions from the initial COVID wave and subsequent dislocations as new variants continue to emerge. Tight labour markets, which combined with COVID fatigue, have increased the number of people voluntarily looking for new, better paid opportunities. Higher average savings from 2020, which have contributed to lofty valuations in various financial markets, and high commodity prices. Gold has historically performed well amid high inflation. In years when inflation was higher than 3%, gold's price increased 14% on average. Further in the long run, gold has outpaced US inflation and moved closer in pace to money supply, which has significantly increased in recent years. Amid opposing forces, real rates will likely remain low. Despite potential rate hikes in some central banks, nominal rates will remain low from a historical perspective. Even more so, elevated inflation will likely keep real rates depressed. This is important for gold since gold's short and medium-term performance tends to often respond to real rates, which combine two important drivers of gold performance: the opportunity cost and risk and uncertainty. Further, low interest rates, both nominal and real, are shifting investment portfolios more towards risk-on assets. And this, in turn, as we discuss in one of our recent reports, increases the need for high-quality liquid assets, such as gold. Investors are ready to turn the page on COVID, but market pullbacks may persist. It's been two years since the start of the pandemic, and the world seems ready to move on. Global stock markets have strongly rebounded from their 2020 lows, albeit at different rates. But tail events have been on the rise. Pullbacks are likely to continue in the face of a seemingly endless stream of new variants, as well as simmering geopolitical tensions and overall buoyant equity valuations, fueled by a long-lasting ultra-low rate environment. In this context, gold can be a valuable risk management tool in an investor's arsenal. Gold has a proven historical record of mitigating the negative impact of equity market pullbacks in periods of systemic risk. Gold performance is not only linked to investment. It's often assumed that gold's price behavior is linked to investment demand, especially from financial instruments such as gold ETFs, over-the-counter contracts, or exchange-traded derivatives. But this is only partly true. Short-term and more significant price movements do tend to respond to variables associated with these types of gold investments. For example, interest rates, inflation, exchange rates, and more generally, flight to quality flows. However, our analysis shows that gold performance is also linked to other components of demand, such as jewelry, technology, and central banks. While these do not typically result in large price movements associated with investment, they do help underpin gold price performance by either providing support or creating headwinds. We believe that gold can still receive positive, if modest, support in 2022 from key jewelry markets, such as India. However, there is a chance that further Chinese economic slowdown may limit the contribution from local gold jewelry demand. Finally, central bank gold demand, which rebounded in 2021, may remain an important source of demand. There are good reasons why central banks favour gold as part of a foreign reserve, which combined with the low interest rate environment can continue to make gold attractive. This was also evidenced by the fact that 2 developed market central banks last year joined the list of buyers, which has been dominated by emerging markets and banks since 2010. Gold's behaviour will depend on which factors to tip the scale. Here they are here. Gold will likely face 2 key headwinds during 2022. High nominal interest rates and a potentially stronger dollar. However, the negative effect from these 2 drivers may be offset by other supporting factors, including high persistent inflation, market volatility linked to COVID and geopolitics, robust demand from other sectors such as central banks and jewellery. Again, this backdrop, gold's performance during 2022 will ultimately be determined by which factors tip the scale. Yet, gold's relevance as a risk hedge will be particularly relevant for investors this coming year. Also like to point out, from an Australian perspective, great stuff there from World Gold Council, of course, but with a stronger US dollar moving to 2022 generally means a weaker Aussie dollar. So if you are holding gold and in Australia and measuring in Australian dollars, your investment will go up. And that's news for today, everybody. Jump over to ainsleyBullion.com.au for all things physical. That's gold, silver, and platinum. And also check out all of our charts from today's news and take your time looking at those a bit closer. ainsleywealth.com.au for all things cryptocurrency. Still a great opportunity there to buy a piece of Bitcoin or our other range of large cap cryptocurrencies. And goldsilverstandard.com. That's a great place to research our own cryptocurrency that we've built, backed, pegged to real gold and real silver, stored in Reserve Vault and in Melbourne Vault, and also third-party audited once a quarter. A great product as a stable coin, and also a great way to grab a piece of gold and silver as well without having to worry about paying for insurance and storage costs. Enjoy your Monday and start of the week, everybody. We'll catch you tomorrow for more news.